All right, welcome back. We're going to finish up chapter 1 in intermediate accounting in this video. So we're going to talk a lot about the accounting conceptual framework. So this is the accounting constitution, if you will. This helps to provide an underlying foundation for the U.S. accounting standards. So this right here is the conceptual framework. So we've got our objectives. Then below that, we have the qualitative characteristics and the elements. And then we have underlying assumptions, principles, and constraints. We are going to break each of these out and really talk about what falls into each of these categories. So first we have our objectives. So the objectives of financial accounting under GAAP is that it's going to be, as we've talked about before, useful for investment and credit decisions. That is our primary goal. And we want it to be useful in assessing the future cash flows. And it needs to be a picture of all of the resources, so the assets the company has, the claims to those resources, which is liabilities, and the changes in the company's financial situation. So our objectives is to provide this information to the users of the financial statements. So then we fall down into the qualitative characteristics. Now there's a lot under this one, a lot more than we'll see in any of the other categories. But the main things that we want in order to lead to wise financial decision making is we want to make sure we provide relevance and we are representing the financial statements faithfully. We are giving true information. So when we look at relevance, what is relevant to the users of the financial statements? It needs to have predictive value. So as they look at the comparative financial statements to see how the company's done over time, are we able to predict how the future is going to look? It needs to have confirmatory value. Are we able to go back and confirm that all of this is true information? Then we have the materiality aspect of it. Materiality is looking at of how much value is each aspect of the financial statement. How relevant is it? So let me give you an example. If I dropped a $10 bill, a fourth of a mile back on a walk, I'm probably going to walk back and try to find that $10 bill. In fact, I did that fairly recently. It was a fall day and there were leaves everywhere, all over the streets. And I realized I had lost $10. And I was like, I'm going to walk back and see if I can find it, which was super tricky with all the leaves. I walk all over the place, can't find it. And then my daughter's like, it's right here, like at the end of the driveway. How did you not see it? Because of all the leaves. Okay, so that was a material amount to me. That meant something to me, $10. If Elon Musk drops $10, even 10 steps back, is he going to go back and pick it up? Possibly not, because that is not a material amount of money to him. It's not even worth his time. So where a mom and pop ice cream shop may be focused on $1,000 that they've lost, or $1,000 is a lot to them if they were to spend too much on the electric bill that month. That's a really material amount to that small store. Whereas if Apple were to have $1,000 variance somewhere, they might say, you know what, it's not even worth our time to look into. That's so immaterial. So materiality is all about including amounts that are relative to the bigger scheme of things when it comes to the financial statements. So I remember my auditing professor one time talking about a company that had lost $5,000 in some way, and they were super concerned about it. And he's like, overall, this is really not a material amount to this company, but to you guys, it is material. So we're going to look for it. So it's all about whether or not it has a big enough impact to make a decision, if it's going to alter a future decision. So all of that has to do with relevance. Then we have the faithful representation. So here we want to make sure in our financial statements, it is representing everything truthfully and that we are not leaving anything out. So that means that it has completeness to it. We want to make sure there is completeness to the financial statements. Everything that should be included is there. It is neutral It's not based on opinion. Everything here is just factual, objective. It has a neutrality to it. We also want to make sure it is free from error. So the best that we can do with that is having internal controls and having auditors to be in place to be able to check for these errors that may have gone past any internal controls. So that helps us to have faithful representation. Also, under qualitative characteristics, that decision usefulness is going to be based on how comparable the financial statements are. Is it consistent over time? We want to make sure that we're presenting consistent financial statements that we can compare from one year to the next. It's verifiable. It is timely. We're getting those things to the users in a timely manner, and it's understandable. We want to make sure that we are sticking to GAAP and that we are making it very clear. We are not convoluted. We're not making it confusing, because a lot of times fraudulent schemes happen through trying to make it as confusing as possible, and then it's really hard to trace back what is going on. No, we want to make sure our financial statements are understandable so that it is helpful in decision making. So those are the qualitative characteristics. Then we get to the elements. This part's a little easier. The elements of the financial statements is really just the different aspects, the different categories on the financial statements. So our assets, liabilities, and equity all fall under which financial statement? The balance sheet. Then we have our comprehensive income, which will fall in the income statement. And then we'll have the revenue, expenses, gains, and losses there in net income. So those are the different elements to help with making good decisions. Then we fall down to the bottom row of that pyramid. We have assumptions. When I look at the financial statements for a company, I should be able to make some assumptions. One of those, that it's an economic entity. That means it is separate from any other entity. If I'm thinking about investing in Tesla, I don't need to see Elon Musk's financial statements. I need to see Tesla's. They are a separate economic entity. I don't want to see SpaceX in that. I want to see Tesla alone. So that is the economic entity. Going concern. This is saying that unless otherwise stated, I am assuming as an investor or creditor, this company is going to continue into the unforeseeable future. We are not expecting it to go out of business. So going concern means that we are going to expect it is going to continue as a company year after year unless otherwise stated. That is an assumption I should be able to make when I invest in a company. Monetary unit. We want to make sure that everything on the financial statements are listed in a monetary unit. So in the US, we would see it in US dollars. We're not going to be putting this in fairies and unicorns. We're not going to be putting it in the number of inventory items, but it's going to be in US dollars for the US. And we want to have periodicity where we are breaking it out into different periods. We're not just like, yeah, over the lifetime of the company, we've made like $1 million. No, I want to know, how much did you make in 2024, in 2025? How much did you make in January versus February? What were the different periods? What was the reporting for each of those? So all of that I should be able to assume from the financial statements, and GAAP says yes. Those are definitely things we want to be able to guarantee you in that. Then we have the principles. So the principles that fall under GAAP, we have the historical cost. So historical cost is where we're actually going to break down each of these a little bit more, but historical cost is how we are going to represent most of our assets. We're going to have revenue recognition, the matching principle, and full disclosure. I'm going through these quickly because we are going to break these out more in the following slides. So those are our principles. Finally, in the last little section of this pyramid for the conceptual framework of accounting is the constraints. There are always going to be constraints on companies, and the financial statements, there's always going to be a limit to those. One of them is cost benefit. So, mom and pop's ice cream shop is going to have a lot less incentive to go buy some huge accounting software in order to make sure their books are right. Maybe they could just do it in Excel or QuickBooks, right? Whereas Apple is going to invest a ton of money into having very accurate, precise accounting software. That's the cost benefit constraint. You might have a Ring doorbell at your house because it adds a little bit of protection. Well, Taylor Swift has bodyguards. It doesn't make sense for you to have a bodyguard. It doesn't make sense for me to have a bodyguard. We're not famous. There's not a bunch of people out trying to get us, most likely, hopefully. But a Ring doorbell is probably enough for us. It wouldn't make sense for us to pay for a 24-hour bodyguard. That is the cost benefit constraint to the financial statements as well. Bigger companies, it's going to be worth it for them to buy more high-tech, expensive accounting software and have internal auditors and all of that. Whereas a small place, may just be using something very simple. A lot of companies use QuickBooks or Excel for their financials because it doesn't make sense to spend that kind of money on their accounting software. I actually worked at a company, tiny company, but they were spending like $46,000 a year on accounting software. And I'm like, what? We could totally be doing your accounting in QuickBooks, probably even in Excel. So you do not need to be spending this kind of money. It just didn't make any sense. Lots of unwise decision making at that company, and you'll see that as an accountant. You'll pick up on a lot of different financial decisions that probably are not being made wisely. Materiality constraint can also fall under the constraint category because we are only going to focus on things that it's worth our time. It is worth the decision makers considering in that. And then conservatism. As accountants, we are expected to be conservative. So we're not going to say, oh, we're going to go ahead and up these numbers because we think this is going to be worth more. Oh, the value of this went up. Oh, we might win this lawsuit. We're going to reflect that. No, everything we do is very conservative. We want to be almost pessimistic on the financial statements so that it doesn't ever appear to be untrue or that we are stretching the truth. We want to be very conservative, kind of like with a budget. You want to be very conservative with that, with your savings. It's almost like you're taking all of the consideration into your decision making, and it could end up being better, but we want to be conservative to make sure we're prepared for the worst. That's kind of what we're doing as accountants. That's a constraint we have on us. So we're going to go back to looking at the different principles, one of them being recognition. So recognition is when we are recognizing, we are admitting information into the financial statements. When do we do that? We said with cash basis, we do that whenever we have cash come in or cash go out. It's different with accrual basis, which is what we're going to use in GAAP. So revenue recognition, we recognize our revenue. We admit that into the financial statements when we provide the goods or services. Doesn't matter if we got paid ahead of time, we get paid at the same time, or we're going to get paid later. We recognize the revenue when we provide the goods and services. What about expenses? Well, expense recognition, which also comes along with the matching principle, is we want to match the revenue and expenses that arise from the same transactions. So we want to make sure let's say we have an auto body company, we're making all this revenue because we have this building we're using, we have our employees that are working on the cars, we have all the electricity we're using. We want to make sure if all this revenue we show in January from working on these cars, we match up the expenses it costs to get that revenue. Even if we don't pay our employees till February, even if we don't pay for our utilities until February, we want to show the expense in January because that's what resulted in the revenue that we got, right? We had to have the utilities, we had to have the employees to get that revenue. So we need to show it in the same time. So we have 4 different approaches to this. We have cause and effect. So because of this revenue, because of this situation, it resulted in this expense. That's when we want to recognize it. I just mentioned the associating an expense with the revenue that we make. So we worked on these cars, We want to make sure the people who worked on it, their salary expense is in the same month. Systematic and rational. So we want to make sure that it makes sense. There's a system to it. It has rationality behind it. It is not just on a whim or when we get around to recording it. It needs to be rational. And it needs to be in the period that it was incurred. If we use the electricity in January, even if we're not paying for it until February, we incurred that expense in January. That's when we need to show it. So that's where we really get into that accrual accounting. Disclosure. So we have all of these financial statements. We have the balance sheet, the income statement, statement of retained earnings, but sometimes there are things that need to be reported, that need to be considered by decision makers that didn't fall into those categories on the financial statements. So for that reason, we need to make sure we're disclosing anything else. These could be notes to the financial statements, is typically how you would see those. We just include that pertinent information. This could be things like the CEO is going to be leaving next year. That's important information. Maybe we're investing in Tesla because we believe in Elon Musk. Maybe that was why we wanted to invest in that. And we're like, oh, I'm a little concerned because if Elon Musk leaves Tesla, then I don't know how it's going to do. Or if it's Starbucks, we were investing in Starbucks because we know that their CEO did so well at Chipotle, and we thought, okay, this is a good time to invest in Starbucks, and hopefully it will also go up by 800% in 6 years. So that's important to disclose. Lots of other things like that would help make decisions. Okay, last little bit here, the measurement. So there's different ways that we measure different amounts under accounts on the financial statements. So we have this mixed attribute measurement model under GAAP. So here's the 5 different attributes. It could be historical cost. A lot of things are recorded at historical cost. This is the original amount we paid for it. So even though on Zillow, your building might be worth $100,000 more, it's okay. We're going to report it at its historical cost. So we'll see building and we'll see the amount we paid for it next to it. And then of course we'll have accumulated depreciation. So we're going to have that below it, but for the most part, the physical assets we buy, we're going to show at historic cost. We're not going to show it constantly. Oh, well, today realtor.com said the building went up. Oh, well, today this investment looks like it would be higher. For the most part, we show our assets at historical costs. Then there's net realizable value. So this is where we are looking at how much cash we're expecting to bring in from this. So this could be more like accounts receivable. So there's going to be amounts in our accounts receivable that we just know inherently somebody is not going to pay us. So we need to report it after the allowance for doubtful accounts. So that would show our net realizable value. The current cost, there are some things that we would show at their current cost, the cost that it would be to replace the item. And then present value. So this would help us to see how much we think the asset would bring in the future. And we do show present value a lot with liabilities as well. And then fair value. How much would someone pay for this asset right now? We are especially going to see this with trading securities. We're going to be showing the fair value if it's something that we are not expecting to hold on to for a long time. So there's 5 different attributes for measurement that GAAP will allow, but they're specific to different items on the financial statements. And you know what? That's the end of chapter 1 for intermediate accounting. You can pat yourself on the back when you finish your assignments and everything for this chapter, because I know that intermediate accounting is tough. Stick with me through all of the chapters. I'm going to have all 21 chapters from intermediate accounting 1 and intermediate 2. So stick with me. I will help explain these things. Right now, for the first few chapters, it is review. But then as it gets deeper and deeper into it, it gets very challenging, especially as new information is presented. So be sure to come back, subscribe so that you do not miss the videos and we can get through this course together.